back to Surveillance Midday. I love in those opening credits. One of those equations is Joe Stiglitz and Sandy Grossman's equation from their great paper on asymmetric information. That's like insider trading. We're continuing to follow it here. Dominic Chu maybe will have some more information for us through the hour. What we're doing, though, is a conversation on economics, finance, and investment. Let's do a very quick data check here, looking at equity markets. And we'll bring it up 31 points, up 11,488. The VIX 17.47. Right on to bonds. I want to get through this quickly and get to our esteemed guest. 10-year yield 3.54%. And then we've got currencies as well. Quiet today for the most part. Really not much going on there. And then on to commodities. Gold on the move, as it has been down $17, $13.70 per ounce. He's the Raymond Professor of Economics at Stanford University, John Taylor. Professor Taylor, welcome to the program.
Good to be here, Tom. Thank you.
We've got up here, John, your great photo of getting on track, how government actions and on and on. Getting on track. What's changed since you wrote Getting on Track?
Well, I think there's been more confirmation of my view, quite frankly. The idea was that government actions and interventions caused a lot of the problems we have faced in the crisis and the Great Recession. And I think what's happened in the 2 years since I wrote that book is more confirmation. You see what's happening in Europe with respect to the government actions, the questions about the stimulus package here, and now, of course, the real concern about the debt in the United States. So I feel like there's been lots of confirmation. That was done really early on in the crisis. Didn't have all the information yet, but it's turned out to be, I think, pretty accurate, I'm happy to say.
Here's a recent article by John Cogan and John Taylor, The Obama Stimulus Impact Zero. Beware of politicians proposing public works and other government purchases as a means to stimulate the economy. They did not work then, and they are not working now. As you know, John Taylor, Matt Shapiro at Michigan has looked carefully at what we do with the free lunch. We're getting a free lunch in the payroll tax. How much of that will go to consumption, and how much of that will go to pay down my charge card?
Well, I think it's going to be mostly pay down, quite frankly, because it's temporary. If it's viewed as temporary, people won't spend that much of it. That's what we saw in 2009. That's what we thought in 2008. That's what Milton Friedman and Franco Modigliani predicted long ago. So my best guess is it's a small impact on consumption. And but I think more significant in terms of stimulus is extending the tax cuts across the board, and with the hope that they would be made permanent in a couple of years.
How do you equate in $858 billion of new stimulus along with $600 billion of QE2? I mean, to be kind, it's an accommodative policy. Have you ever seen accommodation like this?
No, I think in particular QE2 has been a concern to me all along. I argued against that before they went ahead, and I think that it's a lot of people complaining about it. I don't think it's doing much good. If you just look at the Treasury rates, of course, they've gone the other direction since since August, when the chairman hinted in this direction back at Jackson Hole. The 10-year rate's gone up by over 100 basis points. So you have to have some unusual way to prove that it has an impact in the other direction. In
honor of John Taylor, folks, we're going to show you two elegant charts. Here is the Fed balance sheet. We seem to be using this every day, John. $900 billion, and up we go, near $2 trillion. The red circle, folks, is Jan Hatzius's maximum measurement out, another $2 trillion to $4 trillion, and that orange circle is the $600 billion of QE2. John Taylor, do you have confidence that Chairman Bernanke, when he needs to be restrictive, can bring in those assets?
I'm quite worried about it, quite frankly. He laid out a number of tools by which to make this happen, but that's not a strategy for doing it. So you could also bring it back too fast and cause some damage. So it's getting it right that I think is difficult. So frequently the best intentions don't really work out, and that's the real concern to me. I think their intentions are correct, but so often it doesn't play out that way. So there's tremendous uncertainty that's been caused by not only QE2, but QE1.
Folks, and again, we're looking at the insider trading scandal. More with Dominic Chu as the news happens on that big story of the day. John Taylor, this is a chart. I kid my team. I say we're going to be showing this every day. Taylor, rules or discretion. Here's the great moderation, John Taylor, from 1980 down from 14% 10-year yield. I threw a regression on it, that red trend line, and it, 3.54%. John Taylor, some people would say that's a good interest rate. That's success for the Fed. At what interest rate do you worry about the great moderation being over?
I don't look just at the interest rate, quite frankly. I look at the recovery of the economy, the unemployment rate. Remember, the great moderation was a period where we had these very long expansions and very short recessions, and that's obviously been interrupted by the Great Recession. It could come back if the Fed gets back to the strategies that they used in those days, but it didn't focus on a particular interest rate. Remember, it focused on moving the interest rates, sometimes preemptively, but generally in a way that people understood. And I think that was a great benefit to the markets and created stability at the time. I hope we get back to that as soon as we can.
John Taylor with the Stanford backdrop behind you. I visited you in March with your Stanford Economic Policy Institute, John Chauvin's great effort out there. And 1 year ago or so, Martin Feldstein of Harvard stood up at Stanford and said the dollar must go down. Well, Professor Taylor, Professor Feldstein got his wish. Here's real trade-weighted dollar. We showed this with Nora Rubini earlier in the hour. I was shocked by this, John. We've really seen dollar erosion. What does that signal to you when you see real trade-weighted really approach 30 or 40-year lows?
Well, I think the movements of the dollar, to the extent they're not forced in one direction by policy or another, are just fine. I think the concern you have with the policy we're looking at now is efforts to drive down the dollar. That is very dangerous and not constructive. So I don't like to think of the dollar as an instrument of policy. That's something that comes out of the markets. And the best thing is to have policies that support the purchasing power of the dollar, strong dollar, and not to think about the dollar as a way to stimulate the economy. That results in poor policies.
John, I want to come back with you. We're going to continue with John Taylor of Stanford University. A lot to talk about. Let's bring up again his book. This is a short book, folks. We got another must-read today from John Taylor, but this is his current book, Getting Off Track. Why is it good? It's a group of smart people forcing you to think about the crisis we are living in and the economic recovery we're looking for in 2011. Getting off track, certainly what we're looking at. We're also looking, of course, at insider trading. Dominic Chu will have more information on that. From New York, it's Surveillance Midday. Folks, we continue with John Taylor of Stanford University. Professor Taylor, let's go domestic. Simon Johnson of Sloan, Voodoo Economics Revisited, this out on Project Syndicate. Folks, that's a great site. Project Syndicate out of Prague, the Czech Republic. Voodoo Economics Revisited. There's no sign that Democratic leadership is ready for a mature conversation here on the consolidation. You can read it there, folks, as it is from Simon Johnson. Professor Taylor, how should the Republicans respond to the new Washington?
Well, they should come through with some clear plans to begin reducing the deficit. I think that's what they're talking about. They've got some suggestions from these commissions to go ahead with it. Paul Ryan is going to be chairing the House Budget Committee. He's got a lot of good ideas to proceed. So I think they should, as soon as possible, January 5th, get started with that. And there's a whole range of things to do that gone from the budget to health care to tax policy to monetary policy. So I think they seem to have good intentions at this point. Let's see what happens.
Where did the character go of our good intentions? If we look at this as a generational debate, how do we get back to the land of Scoop Jackson?
Well, the most important thing is to focus on the basic principles that have worked. In the economic area, that's worrying about incentives, worrying about long-lasting types of changes, stop with these short-term stimulus. I think they haven't worked, and we've learned just in history, Tom. You know, in the 70s we tried this stuff and we had a mess. In most of the 80s and 90s we went back to fundamentals and things worked pretty well. Now we've got, as I call it, off track again. So I think that's what we need to do. The fundamentals of sound monetary policy and sound fiscal policy will pay off.
John Taylor with us, folks, Stanford University. John, I spoke to Ethan Harris this morning on Bloomberg Surveillance, and in speaking to him, I asked him if the rise in the 10-year yield is sustainable.
It's normal to have interest rates rise in an improving economy. I do think, however, there's a component of this which is a little more concerning, and that is I do think the markets are beginning to smell a lack of fiscal discipline in Washington, that there's really no plan for eliminating the deficit in the long run. I don't believe that they should be trying to eliminate the deficit now because we're still in a recovery stage for the economy, but it would be nice to at least see a tiny hint of a plan going forward.
Ethan Harris of Bank of America Merrill Lynch. You look here, John, and I think of your noted effort with the Taylor rule. What about rules and discretion? Give us a Taylor upright. What are you teaching your undergraduates about rules and discretion vintage 2010?
I'm teaching them there are great benefits for rules-based policies that people can rely on and provide predictability of policy. And I'm also teaching them there's great harm caused by deviating from these and discretionary actions. We've seen that so well in the history, Tom. It's a matter of just looking back and learning what worked and what didn't. That's what I'm telling my students and as many other people who will listen. It's really basic sound economics and worrying about inflation, keeping inflation down, making sure we don't get back to the bad old days. We can get back to the good old days of the 80s and 90s, in my view, those long expansions and short recessions, if we just follow those basic principles.
How do we establish those principles? What is the process you'd like to see to have a more rules-based central bank?
Well, with respect to monetary policy, I have a proposal to reform certain sections of the Federal Reserve Act. Actually, Paul Ryan and I did an op-ed a couple weeks ago outlining how that would work. I think that's the thing we need to think about. We had more accountability and reporting in a lot of the 80s and 90s. I think that will help quite a bit. With respect to fiscal policy, I think we got to get started right now with reducing the deficit. It doesn't have to be draconian, but we have to start, show that it's possible to reduce the growth of spending. So far, we haven't started.
John Taylor, thank you so much. With Stanford University, of course, Professor Taylor with the Hoover Institution as well.